podcasting from a remote location somewhere deep in the heart of New York City. This is Crypto Characters, and I'm your host, Jason Nagy. Our guest for today is the amazing, unstoppable Rosario Ingargiola, CEO and founder of OTCXN. Rosario, welcome to the podcast.
Thanks, Jason. Nice to be here.
All right, so you are the epitome of the interesting folks that you meet in the, let's call it, crypto world. You've got a company, you're a serial entrepreneur, right?
Yep.
You've worked in finance.
I have.
You did trading as well, right?
Well, a little bit of trading, mostly for personal, but been in and around institutional trading technologies basically my whole career.
And you've now founded another company called OTC Exchange Network, right?
Right.
And that focuses on crypto and fiat trading. Is that correct?
That's correct.
So why don't you tell us a little bit about what you're doing with OTCXN, what it does. We can talk about your journey, and we'll get into it.
Yeah, well, started it actually it's been probably about 4.5 years now. Quite a long technology build out. At the heart of it is really a real-time collateral management system. But the core value proposition and kind of what we had in mind when we were building it out was really how do we use technology to eliminate trading counterparty and settlement risk. And so that's kind of...
what do you mean? Let me stop you right there. What do you mean by trade counterparty risk and trade settlement and counterparty risk?
Yeah, so when you transact with other people, you obviously have a counterparty to that transaction. Somehow those transactions have to be cleared and settled. And so in a traditional market, like for example the foreign exchange market, which is what I was in my prior company, where I built a whole FX exchange stack, our clients and ourselves, when we did liquidity provision on an agency basis, we would use what's referred to as a prime broker. And I know that term comes up a lot in the crypto sphere these days, but prime brokerage has a very specific meaning. When you become a client of a prime broker, you actually trade legally and financially in the name of your prime broker. And prime brokerage, for example, in the FX space, is a service provided by only tier one banks, so Citibank, JP Morgan, NatWest, folks like that. And so the point of it is to eliminate counterparty and settlement risk. So two hedge funds that want to transact in the fiat world in FX, they do that through their respective prime brokers. And by virtue of trading legally and financially in the name of their banks, in other words, on the credit lines their banks provide them to face their counterparty, they no longer have to worry about each other as counterparties, and they don't have to worry about settlement at the conclusion of the trading day. That's all handled by the prime broker. So their counterparty risk, if you will, is actually their counterparty's tier one bank. And so that has no analog in the cryptos business, and it also is sort of a very it's very hard to get a prime brokerage relationship these days, even in the fiat traditional world.
Okay, so let's just kind of step back. So counterparty and settlement risk just means that whoever you're trading with, you want to make sure they can actually pay you. They have the stock, they have the currency that you're trading, right?
Yeah, ultimately that any obligations of theirs are gonna get met, and that you are not subject to them, their balance sheet, whether or not they blow up and before you actually get paid.
And so that problem, we'll call it a problem, right, was solved by the concept of prime brokerage. Is that kind of what you're saying, or that wasn't solved by it, but that's one way around it? Explain for everyone.
Yeah, absolutely. So it is solved by it. So in a traditional market like the foreign exchange market, that is the solution. The solution is very big bank balance sheet, and so obviously. As we've all seen with regulatory environment on the banking side, traditional banks, particularly since the Swiss National Bank sort of unpegged the Swiss franc against the euro and caused a really big dislocation in the markets back in 2015. At that point in time, a lot of the big banks started to de-risk and get out of prime brokerage. So it's hard to get prime brokerage these days in traditional markets, and there is literally no analog other than, for example, what we're doing in the digital asset space.
So I'm actually surprised to hear that it's hard to get prime brokerage. So I know people do trade, When you say prime brokerage, do you mean for individuals trading, consumers, or do you mean for anyone trading? Is it different levels? Can you explain that a little bit?
Yeah, well, prime brokerage is typically reserved for very large institutions. So after those sort of market events that I just described, the balance sheet requirements got very, very large for people to be able to achieve those types of relationships. Because effectively, what you're getting underwritten by that tier one bank to trade, in their name. In other words, they're giving you credit.
And that you is anyone that wants to trade. Is that correct?
That you is really significant institutions is primarily what I'm talking about. Obviously, smaller institutions and retail folks, they would usually use some kind of a brokerage setup that gives them access to the market. So this is really for example, the true interbank market. Very large firms like how somebody like Citadel might trade with somebody like Tudor, as an example, or with another major bank.
So these fairly large companies require prime brokerage to trade with each other.
Correct.
Okay. And so we're now so when you say prime brokerage, we're in the realm of large trading partners, correct?
Yes.
All right. Now, you also mentioned something about liquidity provisions. Can you explain what you mean by that?
Yeah, sure. So a lot of the FX market obviously has a very wide range of participants.
And FX means foreign exchange?
Yes,
okay.
Foreign exchange market, so currencies. But there's a difference between deliverable and then a lot of what goes on sort of in the hedge fund trading arena. But basically, liquidity provision is synonymous with market making. So you have both bank market makers, for example, the big banks themselves, Citi and Barclays and you name it. And then you also have non-bank market makers, which are generally very large hedge funds or proprietary trading shops like Jump or Tower Research or Citadel and folks like that.
And each one of those are market makers?
Yes, and the banks obviously perform multiple functions. So they're often the prime broker as well as a market maker, and they may have even other roles in the FX arena. But the hedge funds are predominantly they represent about 40% of global liquidity at this point.
Which indicates that the prime does that it's an actual question. Does that really mean that prime brokerage is no longer being used and hedge funds are trading with each other, or does it mean that it's still being used but the primary traders, the primary entities that are trading are global hedge funds?
Yeah, it's still being used, absolutely. I mean, it's the primary way in which counterparties face each other in the activity that I'm referring to. And basically, there's really not another way to solve for that problem. So what I'm referring to though is when I say balance sheet requirements have come up and you're essentially getting underwritten from a credit point of view by a tier one bank to go out and have potentially billions of dollars of exposure in the currency markets, they obviously want to make sure you have the wherewithal to handle the losses that may result. So very few institutions can qualify for that level of relationship with a tier one bank.
Okay, gotcha. So now let's step back to prime brokerage. Okay. How does the prime brokerage issues and the lack of prime brokerage, how does it connect with what you're doing at OTCXN?
Yeah, so I'll give you a really interesting example. So when I exited my last company to an investment bank in New York, my first thought in looking at the crypto space was to do something similar to what I had done there, which is build a platform to aggregate global liquidity and smart order route, out to those different sources of liquidity. And so I started looking at all the exchanges and thought about, hey, why don't we look at aggregating all of this exchange liquidity and and offer that as a service and give a more institutional service offering around that aggregated liquidity.
So let me stop you there. I want to understand what you mean when you say to aggregate global liquidity.
Yeah, so in the markets, there's kind of, going back to the FX market example, there's kind of two flavors of liquidity that you can trade on. There's really three flavors. There's ECNs that operate like exchanges. So when you think about somebody like CBOE's Hotspot FX, for example, that's an example of an ECN.
What does ECN stand for?
Electronic Communications Network. So it's basically like an exchange, but without being sort of a centralized sort of national exchange.
Okay, so you're talking about ECNs. Go ahead.
Yeah, so that's one flavor of liquidity, and that is a place where people gather both liquidity providers as well as individual clients and can transact in sort of a central limit order book. Other types of liquidity.
Well, let me ask you something right there. So when you say that, when you talk about a global order book, right, that means that there's this network that people are using, and they're using it as a essentially a place to go to trade. Is that what you mean?
Yes.
Okay. So when it's an ECN, tell me how that's different from another feature. I mean, is that, I guess the question is whether or not something is an ECN, is that relevant in any way to understanding the solutions that you're dealing with? Is it different for an ECN versus a national market service or something like that?
It is, because it implicates the fragmentation of the market. So kind of what I was about to illustrate is
Sorry for interrupting.
No, not at all.
You were getting there.
So ECNs are one sort of flavor of marketplace, if you will, or a place to go get liquidity. The other alternatives are what they refer to as like a single dealer platform. So that would be something like, Citibank or Barclays giving you the Citibank or Barclays front end with FX rates in it that you can transact on, where you're transacting solely on their rates.
And what would that be called?
Those are usually referred to as single dealer platforms.
Okay.
So single market maker behind, in other words, one liquidity provider, the bank itself.
All right. So breaking this up just so that it's clear to me and I ask you smart questions. So there's ECNs, which are just platforms where people can trade. Then there's, what did you call it? I didn't write it down. The if it's Citibank or something.
Like a single dealer platform.
Then there's single dealer platforms. And I take it there's a bunch of other platforms that you're going to tell us about now as well?
Well, there's at least one other sort of major flavor of liquidity, and that's liquidity aggregation, where you have a platform that takes in liquidity from many different liquidity providers, banks, non-bank, proprietary trading shops or hedge funds, as well as even ECNs like a Hotspot, and aggregate that into one global order book where it's all transactable through your one credit line with your prime broker. And so that's kind of the other and third major flavor of accessing interbank liquidity.
So now, okay, so you've mentioned liquidity a couple of times. When you say liquidity, do you mean interbank liquidity? How do you mean by? I want to understand the relationship between providing liquidity and what these markets do.
Yeah, so liquidity just means the ability to get a, there's a bid and offer there, and you can get a position on.
So is the liquidity just because someone is willing to buy and another is willing to sell, or is someone funding the purchase?
Well, you have actually a little bit of both, right? So in a traditional prime broker credit model, you have everybody is trading via the prime broker's credit. In other words, so they are financing those transactions by issuing credit lines to the counterparties that are transacting. But the main thing that I was trying to describe was just the fact that there is a lot of willing buyers and sellers, whether those are people that have natural interest because they're a bank, or whether it is somebody who's actually making a market algorithmically based on some quantitative models.
Okay, so effectively, when you're using the concept of liquidity in these circumstances, what you mean is that they're really providing a market. In other words, when I say market, I mean like I'm going to go down to get some eggs, and I'm going to go down. I'm going to get some bacon and some fruit, and I need to go to a place where I can take my money to buy those things. So when I say market, that's kind of in the very old sense of market. That's kind of what you're talking about when you say liquidity.
Exactly.
So now, does that extend to matching a buyer and a seller, or is that something that's different?
It does, and that brings in some additional sort of nuances in terms of the different marketplaces that we talked about. So an ECN is typically what they refer to as a CLOB or a central limit order book. What that means is that you can post a resting order that everybody else that has access to that marketplace can see your order there in the book. They may not know who it is if it's non-disclosed, but they can see that order in the book.
Okay, gotcha.
And then on liquidity aggregation, it's a little different. You see all the liquidity that you're bringing into the aggregator, and then you're smart order routing out to the best price based on price. And you don't necessarily, those can also be relationships that are disclosed or semi-disclosed. They don't have to be disclosed relationships.
Gotcha. All right. So recapping, and then we can bring it back to where you were going. There's at least 3 different types of places where people will go to trade. I'm not going to use the word market because there's that can be a specific thing. So there are these 3 types of trading platforms that you can use where buyers and sellers of stock, let's say cash or currency, can go. And what you're doing is you're putting them together to make them into a single place where everybody can go. Is that the next step to what OTCXN is doing?
Yeah, so how we got down that path was we talked about this initial concept when I was getting into the crypto space of looking at how to do liquidity aggregation. So liquidity aggregation in the crypto space would mean connecting to multiple proprietary traders or dealers that are streaming executable quotes, as well as other institutional and retail exchanges, for example, and then creating a single consolidated order book of all that liquidity and then making that available to clients through sort of a more institutional service offering than you get when you go to, for example, a retail exchange. So that was the original idea that I had when I started taking an interest in learning about blockchain and learning about crypto back in 2015. What I realized, and this is kind of tying back to how prime brokerage fits in and what our value proposition is, there was no way to actually do that, because in the traditional markets you can get a clearing relationship and you can actually clear and settle all that business, and therefore it allows you to do that aggregation. In the digital asset space prior to OTCXN, there was literally no way to clear and settle that business cross-exchange. So you could not take 2 retail exchanges and aggregate it and show it to people and let them trade it in one account in a way where they didn't have any counterparty or settlement risk. And so that's where there's some additional nuance, but there's a lot of people talking about clearing and settlement. There's a lot of people sort of misusing the term prime brokerage, and there's a lot of people even talking about aggregation, but you really have to understand what you're getting and where the risks are, as you go down that path.
Okay, so let's actually talk about that. Maybe go into the types of the manner in which you can have this counterparty trading and settlement risk between if you're purchasing or selling crypto and you're on exchange A versus exchange B. And did I get that right? Is that effectively one of the issues you saw initially?
Yeah, that's one of the issues. What we're really solving for is eliminating that counterparty and settlement risk. But the issue, that you just described, where you have different risks between 2 different exchanges, you really have to kind of take a step back. Let's look at the way people transact today.
Let's do it.
To trade on an exchange, a crypto exchange, for example, you have to put assets at the exchange, generally speaking, which means you now have that exchange as your counterparty, and you have risk to how they manage their affairs. In other words, if they have a hack, you could potentially lose your assets. If they employ various tactics in terms of how they do execution, which may not be up to snuff in terms of how we run more regulated markets, you're subject, to some of that as well, obviously. But the bigger issue is that you have to open an account, you have to put assets there, and so now they're your counterparty in effect. You have some risk to that exchange.
Because if you're putting cash in, they can get stolen if you're putting crypto in. They can get hacked. Is that what you mean?
Yeah, or they could,
Okay.
sort of maybe die and go away, or somehow the keys are lost, or whatever the case may
I've
be.
never heard of that.
So
But let's just. You're talking about it's Quadra X, right? Is that the one?
yeah, something like that.
The Canadian or
Quadriga.
Quadriga. You know what? I've said it wrong on this podcast every time. But why don't you tell everyone about what Quadriga is and what happened? Because it's not a good story, but it just shows some of the dangers that you can solve.
Yeah, that's right. I mean, that's a case where a founder that was the sole party that held the private keys to all of the crypto assets custodied by the exchange, disappeared and then was said to have died, and now there's this sort of, is he really dead, and
Well, I mean,
where's all the money?
let's give the interesting part of the story, right? He went on a honeymoon with his wife to India to build houses, right? Took his laptop, which had all of the information on the exchange, like a laptop, like something like this, only slightly bigger since this is an iPad, right? And then died of colitis, right? I mean, that was what was reported, that he died of colitis.
Yeah.
Right. And was he cremated? Is that also correct? Like, was there an immediate cremation or something like that?
Something crazy.
I forget. But it and no one's, and so now there are people out there that say that maybe he didn't die, but no one really knows. Is that right?
Yeah. I mean, nobody really knows, and that's not the only. There's been plenty of well documented hacks. I mean, I think now the losses are in this multiple billions of dollars in terms of actual assets that have been permanently lost by virtue of exchanges custodying client assets. So that's one way that people can transact in the digital asset space today. The other way that people transact is what is off exchange, what people refer to as sort of an OTC trade or an OTC block trade.
What does OTC mean?
It means over the counter. So in other words, off exchange.
Okay.
Don't get me started. I won't talk about how all crypto is actually over the counter, but let's.
Well, I mean, we can actually talk about that. Well, actually, why don't you talk a little bit first about what OTC means? Because way back when, that really meant that you were trading on the pink sheets, right? Isn't that what that really meant?
That's one of the things that it means, but it also, for example, all the biggest market in the world, the FX market, which is now, I think, last Bank for International Settlements triennial survey, I think they said it was at like $6.3 trillion a day of turnover in the FX markets. That whole market is an over-the-counter market. So
okay.
Many very large derivatives markets are over-the-counter markets. So it just basically means not on a centralized sort of national exchange that's regulated as such. And so the overwhelming majority of trading is actually over the counter, and crypto assets are all over the counter instruments, even if they're trading on a retail so-called exchange.
Okay. All right. So, but I want to make sure, I think I know why, but what makes crypto over the counter? Does it make it over the counter because there's no prime brokerage relationship? Like, what is the essence of what makes crypto over the counter versus something that is not an over the counter trade?
Yeah, I mean, it's quite literally just that it's not mandated to a regulated national exchange. So that makes it an OTC instrument, right? And so if you look at like the crypto assets that are deemed to be commodities like Bitcoin and some others, where the CFTC has been clear, that they consider those to be commodities, those are regulated in the same way that spot FX is regulated, as an example.
Okay, gotcha. So effectively, over the counter is everything that's done where it's not on a national market. Is that correct?
Basically, yeah. And it's a
how many national markets are there?
Well, I mean, it's mostly applicable to the equities markets in the United States, at least. So there, for example, there is no. That's why FX is an over-the-counter instrument. There is no sort of national centralized exchange,
for currency.
For currencies.
Gotcha. Okay, so nearly all currency trades are over the counter, right?
That's right.
And then, what kind of stock trades, or let's say equities trading? What kind of equities trading are over the counter? Is it stuff that's below NASDAQ level? Is it stuff that's below S&P?
I don't think it's actually. I'm not a huge equities guy, but I don't think it actually relates to sort of the stature of the company, or I think it actually has to do with just any trade that is not that's not listed on a national exchange. So if you for example, like maybe a private company shares trade between two parties, I guess is technically over the counter. Again, I'm not a regulator and I'm not a equities guy, but I believe that's the case.
Okay. Well, I mean, all of this is from a business perspective anyway, in a business case. So, all right. So now, excuse me. Let's go back to OTCXN and kind of your vision and what was going on. So,
yeah. So this second way of trading, these OTC block trades, if you think about how those transactions occur, somebody has to go first, right? If I have to literally wire a dealer dollars and wait for them to send me Bitcoin, and that transaction in terms of settlement time includes the public ledger transaction, which can be some number. I guess people like to see 6+ confirms to consider it done.
So let's actually break down what you just spoke about for folks that aren't really into crypto trading or just kind of getting around here. So I want to go buy Bitcoin, right? How do you do it?
So there's two ways. You open an account at a retail exchange and you put your money there, and you now have that exchange as your counterparty risk. Or you interact with a dealer, which usually you can't do unless you're quite large, but that dealer will basically make you send them dollars, and then they will send you Bitcoin after they have confirmed the receipt of your dollars. So now you have their counterparty and settlement risk. In other words, if you wire them dollars and they don't send you Bitcoin, you lost your dollars.
Right. Okay. And then there's another way to buy and sell Bitcoin too. I know that you have Bitcoin. I say, hey, I'd like to buy some Bitcoin from you. And you say, okay, I'll sell it for however much you're going to sell it. And then I say, okay, I'd like to buy 1 Bitcoin. And you say, okay. And I give you money. And then you transfer the Bitcoin from your wallet to mine. That's the third way to have a cryptocurrency transaction.
Yeah, that's right. And it's a similar problem unless we're
all sitting in the same room with weapons.
Exactly.
Excuse me, weapons, computers. Right.
Exactly. So that's basically so solving for those issues. You could do that with prime brokerage. So to take that analogy and apply it to crypto now, if somebody like Goldman Sachs stood up tomorrow and said, we're going to become the central counterparty or guarantor of all the trading transactions between the counterparties we approve, and we'll take that risk. We'll make sure that nobody loses money. We'll put our balance sheet at risk. That would be one solution.
Has anyone done that?
Absolutely not. So unfortunately, we're a long way from that happening, and that's and so the idea that I had was to essentially use technology to solve that problem. And so it's closely related to the issue that I described, where originally my idea was, let's aggregate this liquidity, let's let it make it possible for people to transact on that aggregated liquidity. There's basically no way, because there's no prime broker, there's nobody to guarantee the clearing and settlement of those transactions. So in other words, there is quite literally no way to facilitate that without just paperwork and trust and things like that. So we focused on essentially, I was learning about blockchain at the same time and kind of had this aha moment where I realized that you could actually use blockchain in combination with traditional financial markets, trading technology, to craft a pure technology solution that can eliminate counterparty and settlement risk and essentially deliver prime brokerage without us being in the middle and without us using our balance sheet, and that's how we got started.
Okay, so tell me how you do it.
Yeah, so
you figured it out, right? I've seen you speak at events. We've spoken for years about kind of like your ideas. So you did accomplish that, correct?
We did, It was a very long road. I mean, it was. Looking back on it now, it almost feels like I start thinking about kind of like how deep tech work. I mean, this was literally a 4+ year build out. At some point we had we had over 50 people, and most of it was engineering. So we had to basically build a whole range of different components. And so there's 4 major parts to the technology stack. There is an asset tokenization aspect to that. And that is,
why don't you explain what that means?
so asset tokenization is, there's many different flavors of it these days, but what we don't actually create a token on something like an ERC20. We also don't have a native token in the same way that you have certain types of asset tokenization. So this is really tokenization of an asset held by a custodian on behalf of a client, so that it is digitally represented in terms of ownership on a custodial blockchain ledger, and then can be transacted where you have cryptographically provable changes of ownership that happen as it transacts. And I'll talk a little bit more about how it all fits together.
So let me break that down, because there was a lot of there's not a lot. There were some words in there that, to the uninitiated might be a little confusing. So what you're saying is that you create something that only exists on your system called a token, right?
It's technically on the technology stack that we give to the custodians that are part of our network, but yes,
Okay.
we give them the tools to do that, to tokenize an asset that they're holding for a client.
So let's step back one more time. So there's a technology platform that you give to custodians, correct?
Correct.
And then what the custodians do is it's effectively like a balance sheet, right?
Yeah. They the first step is they have to, with a few mouse clicks, they can create a new blockchain ledger in their node for any asset that they want to support on the network.
Okay. So, all right. So they created, what did you say?
A new blockchain ledger. So, for example,
Okay.
to get started, they might create a new dollar ledger, a new Bitcoin ledger, but they can do this for any asset, digital or not natively digital.
And that never goes off of the technology platform. It's just a ledger, a note in a ledger that they maintain, correct? That's what you mean by it's not an ERC20 token, which is the tokens that are used by Ethereum, correct?
Exactly.
Okay. All right. So they create something that exists only on their space, and it's like a marker.
That's right. And essentially the parties, through the way it's papered, they basically agree that those custodial blockchain ledgers become the golden source of truth as people transact. So the client essentially initiates the request to take an asset that they're holding there and to tokenize it onto that ledger, so that it's then freely tradable with anybody else in the network.
Okay, so let's use the words buyer and seller, because I think it's easier to follow.
Sure.
All right, so seller goes to a custodian, correct?
Right.
Seller says to custodian, I have 10 Bitcoin that I'm willing to sell, correct?
Yep.
Custodian says, okay, creates, double checks to make sure that the Bitcoin exists on the balance in the wallet of seller.
Yes.
Confirms that the seller, in fact, has the Bitcoin via creating another entry on the blockchain ledger that's internal.
Correct.
Then what happens?
Well, before they create that internal blockchain ledger entry, they put an administrative lock on the asset so that they can't double spend it. So in other words, they can do that however they see fit, but typically what they'll do is they'll have a reserve wallet. So if that 10 Bitcoins that the seller wants to transact, he can put a request in to do the issuance, in other words, to tokenize it onto that internal blockchain ledger. The custodian will maybe move they might move the 10 Bitcoin into a reserve wallet for use on OTCXN. It's not a wallet we control. It's still a client-controlled, or really a custodian-controlled wallet that gives them the ability to basically guarantee that asset is there when the ownership changes and somebody shows up and says, I'd like my 10 Bitcoin.
Gotcha. So effectively, the custodian is taking on the counterparty risk, and what it's doing is it's saying, okay, you tell me you have 10 Bitcoin, you transfer your 10 Bitcoin to this wallet here, and then the custodian holds it there, however it holds it, and it knows that Bitcoin hasn't been traded from the time that you said you had it and it confirmed it until the time that the transaction goes through between a buyer and a seller. correct?
That's correct. And they're not actually assuming any counterparty risk. They're
Who's
still
the they?
the custodian. So they're actually still just performing a custodial function. This is just a special set of instructions that relates to how you transact on the OTCXN network.
Okay. All right. So then what happens next?
So once that party has put in that issuance request, which has been approved by the custodian, in the front end that we give to the trading entities, they can now see that balance. And so if they want to transact or sell the 10 Bitcoin, they can do so to any buyer that exists on the network without any counterparty or settlement risk, because that transaction effectively clears and settles instantly against provable assets that are on these custodial ledgers. So the buyer in that case has dollars at a custodian on the network tokenized in a similar way. That transaction is actually an atomic swap that we're able to do between any custodial asset ledger and any other custodial asset ledger.
What does atomic swap mean?
So atomic swap is really just atomic is sort of a computer science term that just means as a single unit. So it's a transaction. In fact, they use the nomenclature in crypto as well. You have kind of cross-chain atomic swaps. They refer to it as. This is very similar, except that we can do it between any asset ledger at any custodian and any other asset ledger at any other custodian. So you have this much more broad and diverse, way of transacting, where the transaction is still either totally successful or a total fail. In other words, nobody goes first. Nobody takes any counterparty risk.
It happens so when you say atomic, you mean instantaneous.
When we mean as a single unit, it does happen instantaneously. So our order books, for example, or our block trading platform, those things are not on chain, but the transaction itself, the actual trade, that change of ownership of my dollars going to you and your Bitcoin going to me, happens in real time on chain at the custodial level. And then the custodian then periodically does the movements of the assets to actually net settle with everybody.
Okay. All right. So when you say atomic, I want to understand, because you hear people use that term all the time. And I always ask what they mean by it. And I know that there's no definition of what an atomic swap is. There's no formal definition. So it's not instantaneous, it's simultaneous. Is that what you mean?
Simultaneous is a better way to describe it. Yeah. So it's
Gotcha.
So it's essentially a guaranteed to be simultaneous transaction. In other words, the ownership of the dollars and the Bitcoin in that example, they literally change in lockstep at the same time as a single transaction, although happening on the two custodial ledgers. And it's implemented in such a way. In fact, I think your firm helped us seek a bunch of patent coverage around this. It's implemented in a way where it's essentially guaranteed to either be a total failure, meaning nobody's asset ownership changed, or a total success, meaning both parties' asset ownership changed.
That's pretty cool. We should be able to do that with actual trading in equities one day, huh?
We can do it today. We don't have the regulatory treatment for it, but we'll get there.
So, all right. So how long did it take for you to figure all this out? Because it sounds like, oh yeah, that makes sense. But there's a lot of steps that you have to go through. And it's not something that it's not a shower moment, where you're like, putting the Irish Spring on and then you have the aha moment when the little wood sprites jumps out and, ta-da. It's not like that, right?
No. I mean, the realization that you could actually use technology with no balance sheet and no trust to eliminate counterparty and settlement risk, that was kind of an aha moment that happened, months into my learning about crypto and learning about how blockchain works. The magic here, though, is really creating that whole picture. Not only the custodial solution that does the tokenization that lets them create new blockchain ledgers. We even had to develop blockchain from scratch because it's a very unique architecture. This is an architecture where you have a unique asset ledger per asset per custodian. And that gives you this kind of very natural, logical sharding if you want to think about it that way.
That they got to come up with a better word.
With a D, not a T.
We also, what was that movie with Philip Seymour Hoffman and Ben Stiller? I just remember it from there. Anyway, every time I hear sharding, it just makes me laugh.
No, I know it is a funny word. So, but in the crypto space, there's a lot of discussions about how do you scale blockchain, and one of the solutions that they talk about is different methods of sharding, which basically just means splintering and taking something, one big monolithic thing and breaking it out across a whole bunch of different smaller pieces. And so,
actually, I'd like you to explain it, because I've heard about it in a manner of data protection, but I'm not necessarily seeing how sharding works from a trading perspective, because it strikes me that you wouldn't need it. So can you kind of get into that a little bit?
Yeah. Well, here let me see if I can really simplify it. So if you think about the transaction throughput you have.
Do you want some water, by the way?
I'm good, thank you.
Okay. Transaction throughput you have.
Transaction throughput you have. I mean, if you listen to people talk about why you can't use, Ethereum or Bitcoin at scale, in a payments network context, for example, that relates to transaction processing and throughput, which in and of itself can be broken down into a whole bunch of things. But let me try to illustrate it this way.
But when you say transaction processing, essentially you're saying that Visa can do 30,000 transactions per second.
Right, something like that.
And Bitcoin can do 1,000 or something like that per minute, or 10 minutes,
it's like 12 or some tiny number.
It's 12.
So it's a very small number.
That's kind of funny. Yeah. Okay, so you're talking about speed right now.
You're talking about speed of actually processing transactions such that there is finality, right?
Okay.
And so you have different problems. Without getting into the weeds, you have different problems depending on the consensus mechanism and things like that. But forgetting all that, think about it as an input-output problem from a computer science point of view. So you have, people refer to distributed ledgers as databases, right? They are effectively a form of database. Right. So in a database, when you're reading and writing to a database, or let's say to disk, a particular file on disk, you have an input-output problem. If everybody is reading and writing to the same ledger, you have a potential bottleneck and you have a slowdown.
You mean the doors aren't big enough for everyone to get into the same time?
Exactly. And there's not enough doors. Let's put it that way.
I've been to Penn Station in the morning, so I know what that's like.
Absolutely. So sharding, and the way we've approached it, is actually to have a common protocol that's part of all of the custodial nodes, but they're able to create unique asset ledgers for every asset at each custodian. So in other words, two custodians on our network have a unique dollar ledger and a unique Bitcoin ledger each, if they're supporting Bitcoin and dollars on the network. So what that effectively does is you have 4 different places where you have IO effectively, as opposed to one. And obviously that gets exponentially more valuable as you start to have more asset coverage.
So you're creating more doors. That's what you mean.
Creating more doors.
Okay.
Right?
All right.
And so that took a unique architecture that didn't exist in any off-the-shelf kind of solution. So we ended up having, so we had to basically build our own solution. It uses the same transaction model as Bitcoin, meaning it's a UTXO set kind of model.
What does UTXO mean?
It's like an unspent transaction output type model that Bitcoin uses for how. So in other words, your value is potentially spread across multiple addresses, but the total of that is essentially your total that you have to spend. So we have a similar concept in terms of how these assets are managed, in our custodial solution. So we built the tokenization bit, built the blockchain, technology stack that sort of underpins it, wrapped that in a nice, neat set of tools for custodians so that they can actually get live without having to do any kind of technology integration work, try to keep those barriers really low in terms of adoption. We also give them financial incentives. And then we had to integrate that into the traditional, the more traditional markets technology. So you have both real-time collateral.
Let me stop you there.
Yeah.
I want to get to that, but going back to essentially what you're talking about with shards. Make sure I understand it. Effectively, what you did was you reduced the transaction wait time by splintering off different pieces of Bitcoin. I just want to understand essentially how that works. I'm curious.
Yeah, so it's not different pieces of Bitcoin, but for example, two parties that want to the two independent parties that want to transact dollar for Bitcoin can do that in that context without necessarily reading and writing from the same ledger. So you have just a completely different model that gives you right out of the box, forgetting all the other optimizations that are possible in a private permission network, and how we deploy that, for example, in very specific Equinix data centers, and how we cross-connect machines between parties and all of that. Putting all that kind of optimization aside, you just have this kind of brute force way of sort of increasing the possible I/O just by virtue of having it splintered across different asset ledgers at different custodians.
I see. Okay. All right. I think I get it.
Yeah. So then the challenge, after we have the tokenization and the blockchain stack sort of nailed down, you have all of the sort of real-time collateral management logic that has to be integrated into that. So, for example, things that exist in a traditional market like real-time pre-trade risk. What that means is essentially reading from those custodial ledgers in a way where we're still not a trusted party, meaning we're not the ones running the ledgers, we're not in control of the ledgers, but we're able to read that in real time into memory, such that when a client goes to put an order on, even if they do it programmatically, we can know whether or not they provably have the asset to back that order. And so different aspects of real-time collateral management, like that's an example of one piece of it. And then, of course, all of the secondary market trading technology that sits on top of this. And so we actually built both a block trading, an OTC block trading platform where people can do request for quote transactions where, like we described earlier, except where the transaction instantly clears and settles against those provable assets at the custodians.
What's a request for quote? That means that I want to know if you'll buy it at X price, or
it basically means give me a price on Bitcoin, and it could be a two-way price, like give me a bid and an offer, and then you decide whether or not you want to transact on that.
Gotcha. So there's a tremendous amount of back office information that you've kind of gone through. What's your background? I mean, you strike me as half engineer, half finance guy, because you have so much background about how things work and the underlying infrastructure of trading. But most engineers that I've interviewed here, they don't seem to. They're good with creating problems and figuring it out, but they don't seem to have the. I don't want to. They're slightly different than you, and I don't really know how to explain it. So I'm really curious to kind of what's your background?
Yeah, I mean, I think what you mean to say is they're sometimes not necessarily practitioners, so they're really more focused purely on the engineering problem. And yeah, I'm kind of a super weird hybrid of business and with some technical capability. So I don't write code, but in my career. I've spent a lot of time. So my first company that I started, actually, I started with a computer science professor at University of California, and we built a platform together. We did a bunch of work together at University of California, which we ultimately spun out through the Office of Technology Transfer, and they allowed us to commercialize it. And we built a very large-scale institutional trading platform that let people build arbitrarily complex algorithmic trading strategies with a big focus on machine learning and AI. And so that...
You did that as a student?
No, I wasn't a student. So I actually met him as a business guy on a hedge fund consulting engagement. And we hit it off, and he had been using machine learning and AI to trade his retirement accounts, of all things.
It sounds like a dubious proposition.
Well, he did. What got my attention was how incredibly well he did. He was literally just switching between different Fidelity mutual funds. So we ended up. I basically wanted to take what he was applying there and create a platform where somebody could use those methodologies to build algorithmic trading strategies, but use their own background and biases and training, as opposed to buying a model that he built, even though it was a quite powerful model. And so we ultimately built this very large scale platform that we licensed to guys like BNY Mellon and Millennium Partners. So that was kind of my first foray into having no choice but to really, really understand deep technical matters. And then obviously the company after that, I built a whole FX exchange stack.
So before we get to that second company, let's go to your first. How long had you been out in the business world?
I was pretty young at this point. So this was early 2000s. I mean, I was probably, I was in the middle of putting together a multi-manager program in the FX space, actually. So I had basically put together a group of hedge funds and proprietary traders that we were raising capital for. And I met Professor Levinson just kind of accidentally and completely went off track and was just super enamored with what he was doing from a technology point of view.
Now, in 2000, how long had you been in? It sounds like you were involved in the trading space before 2000. So how long had you been in that side of the business?
Well, professionally, only a couple of years. I mean, I had obviously traded for my personal account since I was a kid, but nothing at a big firm. So
you were out
been kind of
2 years on your own, and you had an idea that you were going to create what sounds like a conglomerate, although that might be too big of a word, to start trading together. And in the middle of that, you met this professor and you decided you would create a trading platform. Is that right?
That's right. Yeah.
Okay. That's fairly unusual. You recognize that, right? That like most people don't do that.
That's a little unusual. Yeah.
I mean, when I was a second year lawyer, and it's different with a lawyer, I wasn't creating my own law firm to do whatever the hell it is that I do now. Half of what I'm doing now didn't exist back then, but that's a fairly unique personality trait. What gave you the idea after trading or being in the business world for 2 years? What made you think that, oh yeah, I could just get all these hedge funds together and trade?
Well, I was really just putting together. So there are, you've heard of a fund of funds.
Of course.
So it was kind of like a fund of funds, but unique to the FX space. I had an interest in the FX space, was trading some FX, for my PA, and just thought I had stumbled across some really good managers and thought it would be, maybe a interesting idea to actually raise capital and allocate that capital to these managers, and then you have that total return becomes your track record for your fund of funds. So the idea is you basically build AUM and you get paid on AUM over time. And so just
AUM being?
Assets under management.
All right. So I'm going to go back a little bit. You're out 2 years. You decide that you're going to create a fund of funds. You haven't traded in any institutional places, right? You don't have the institutional pedigree, correct?
That's right.
Did you ever think, what am I doing? I'm too young to do this, or I don't have the experience to do this, or I need to get more experience before I could. Did that even occur to you?
No, I mean, it's a certain mentality. It's not
a criticism.
It's painful, so it's not for everybody. But it's you basically learn a lot of hard lessons along the way. And my first company, as an example, we went through the financial crisis, got it up to where it was pretty close to break even, with big institutional clients, and the VC still shut it down. So, these are and we had we were doing something difficult in the quantitative software space, which is a very, very tough place to make money today. I look back now and I think I was insane, but and I also learned that I hate software license models. So now I went from that into my next venture, which was very FX focused, specifically because I could build technology, charge a transaction based fee, which I could not do in equities without being a broker dealer. I could do that in FX when I'm trading with institutional clients or ECP, eligible contract participant clients, as defined by the CFTC. And so that, that was why I went into the FX space, was simply to get away from software license models, get into a transactional model, still trading related, which is sort of a love of mine.
Okay, so I'm not harping here, okay, but I'll give you an example. People find success to be scary, and when they embark on an ambitious adventure, many of them will say, "What am I doing?" Like The Hobbit. You read The Hobbit?
Yeah.
Right. So Bilbo Baggins is, sitting down. He's a fat little guy who eats 3 breakfasts in the morning, and he's got everything happy and easy, and he's got kegs of ale in his basement somewhere where he's got these kegs of ale that he could drink. And then all of a sudden he kind of gets yanked into, this band of thieves with these 12 dwarves or however many dwarves there are. And all of a sudden, and he's like, I can't do it. And then he gets challenged and he's like, no, I could do it. I could be your thief. And this is a guy who's never done anything wrong in his entire life. Right. So that's the fictional representation. But his initial response was, I can't do this. He was literally running away. He passed out. Right.
Yep.
So that's the way a lot of people, maybe they're not going to pass out on a thought process, but what occurred in your mind was, oh, I should create a fund of funds with all of these hedge funds. And there wasn't even, you never said, I can't do that. Am I crazy? How am I going to do it? You just went off and did it. Is that effectively what you just kind of said?
Yeah. I mean,
I find that to be amazing. No, that's great, but that's like true innovation. And I'm guessing you've done that every time. Is that right?
I rolled from that company with Professor Levinson into my last company, which still exists and is being run by an investment bank here in New York. And then when I left that, it was time to do the next one.
Okay, that's pretty impressive. So you've been involved in 3 companies. At least 2 of them are successful. It sounds like the first one might not have been. You've done some tremendous innovation, let's say, and a tremendous amount of thought and work went into creating the OTCXN platform. That's clear. You've got like 3 different levels of blockchain. You're like the turducken of blockchains, right? So I guess what I want to know is, how does it start? Like, does it start with an idea, walking down the street, expecting, where you're not focusing on what you're going to do? How do these things start?
That's a good question. I mean, I think it helps to be sort of passionate about some particular area of business, and if you think about that area of business a lot, you start naturally thinking about deficiencies and how do people solve these problems, and if you have, it's much harder early on. Now it's quite easy to sort of, in my mind, design an enterprise trading system, but it's hard enough to where that's why I haven't gone out and done some other type of enterprise software, because I don't really know anything about those domains. So this is a domain that I know about. I know what the problems are, and so it's just fun thinking about how to solve the problems.
So how do you define success? I mean, there's obviously making money, right? That's how, but that's a very, very large concept. It's like saying, what do you want to be in 10 years? And it's like, well, I want to be, the CEO of the biggest bank in the world. Well, that's great. I'm glad you want to do that, but be a little bit more focused. So when you start a venture, how do you view success?
I mean, for me, the biggest satisfaction comes from actually solving the hard problem. It's much less, and being able to get clients and others interested in backing that idea, whether that's backing it with investment or backing it with early adoption. But for me, it's really just the thing I love is to actually figure out, and actually demonstrate that we can do it, that we can solve the problem, that we actually have a solution.
Okay, so you decide, I think I'm going to focus on this. We'll call it problem X. Do you say, okay, do you set, markers that you want to achieve? Do you say, in the first year, I want X to happen? Or are you just in it organically, and you're kind of living in it on a day-to-day basis, and maybe you're trying to figure out the fastest way for you to make money so that you can turn what your idea is into something that you can implement and grow it from there, something else?
Yeah, I mean, it's a great question. I mean, I think there's probably much better ways to attack it than probably I have attacked it. But for me, this is a great example with OTCXN. This was really merging some very, very difficult, problem domains into one sort of all-encompassing end-to-end solution that's frankly quite large and quite hard for people to actually get their head around to even understand sort of, what it all means. What have we actually built here? That was very much kind of a much more organic process. I mean, we didn't know all the answers. We had to actually, I just remember things like thinking about, well, how do I get around if I take an off-the-shelf blockchain solution, how do I get around this? How do I make it work for a capital markets trading use case where I need my trades to literally happen in real time on chain in milliseconds? And there was nothing. And so we had to figure out, okay, how would we approach this if we were building it from scratch? And came up with the idea to do a multi-ledger architecture. And that's kind of just how it went. The only part that was sort of old hat was really understanding. We have that, I mentioned that RFQ block trading platform, but we also have a full-blown, exchange stack that sits on top of that with a lit central limit order book and an embedded dark pool and aggregation and smart order routing.
So stop right there. Smart order routing, dark pool. What was the other two terms you used?
Lit central limit order book.
And then an exchange stack.
Yeah.
Right?
So
explain what each one of those are so that the uninitiated, including me, could follow exactly what you mean.
Yeah. So the exchange stack is that combination of things that I just talked about. And what it really does is it blends sort of all the different types of marketplaces that exist that we talked about earlier. So you have that, when I say lit, we have a lit central limit order book, meaning like the ECNs we talked about earlier, a central order book where everybody can see everybody else's orders. Then you have a dark pool, which is essentially the same exact thing. It's a central limit order book, except it's not lit, it's dark, meaning nobody can see what's in it. And you automatically, if you put an order into the lit book, you'll automatically get price improved against the dark pool if there's liquidity there at a better price. And then aggregation.
Sorry, I want to ask you a question.
Go for it.
All right, so dark pool, and you said lit pool, right?
Yes.
By the way, always reminds me of Deadpool, so it sounds very nefarious, So a dark pool means that no one knows, no one can see what the bids or asks are.
Exactly.
You put in a bid, and then it's automatically matched up with the best ask. Is that correct?
Right. So
and that's the smart order routing part that you need to have, right?
Well, that's part of it. Not exactly what I'm referring to. So that sort of internal crossing, if you will, between the lit pool and the dark pool is kind of like smart order routing. But smart order routing in this context means that, so when you look at our exchange, if you look at the interface, the liquidity that you see is native resting orders that are sitting in the lit book. That's that
Okay.
lit central limit order book. You don't see the dark stuff, but you get price improved against that automatically. So if you put a bid in, and there's a price that would match off with that's better than what's in the pricing that's happening in the lit book, you'll get crossed against that dark order. The aggregation and smart order routing piece, though, is kind of, this is sort of a hybrid. So because we can clear and settle these transactions, including cross exchange
Instantaneously.
in the digital asset space, we can take streaming executable quotes from dealers. We can take other retail exchanges. All that liquidity is aggregated into the lit central limit order book. So when you aggress on a price, the smart order routing might route that out to the dealer that quoted that price, or it might route it out to the exchange that price belongs to, meaning it's in the actual exchange's order book. So it's kind of a hybrid. I don't know that there's anything else like that in the digital space at the moment.
Let me break this down. What you've done, or what the OTCXN platform allows for, is someone to trade any digital asset with actual currency amongst, no matter where it's held. Like they can trade it on platform A, and they can hold it on platform B, and then they can have cash. And as long as they all have this custodial relationship, it's a marketplace for everyone at the same time. Is that effectively what it does?
That's exactly right. Yeah, and it's obviously cross custodian capable. So put another way, you can transact on all the liquidity on the network with a single account at any custodian on the network. So in other words, when an exchange joins our network, for example, they hold assets, client omnibus assets, not firm assets, but omnibus client money in a secondary omnibus account at a custodian on our network. We can then integrate to their API and show that order book from the exchange to everybody on our network. And when you transact on it, it actually clears and settles at the custodial level against those provable assets held by the exchange in that omnibus account and held by the counterparty that's aggressing on that price. So it gives you this basically the equivalent of what prime brokerage would afford, but it's based purely on technology. We're not. So there are other people that are trying to do something that sounds very similar, but it's really, really important for people that are in the space to understand the differences, right? Because we believe we're the only solution that's kind of really suitable for fiduciaries, because you quite literally don't have counterparty or settlement risk. There are other folks out there.
When you say that it's really good for fiduciaries, it's a very broad term. And in the finance world and the trading world, many different things can be fiduciary. So can you be a little bit more specific? You don't need to name names. And it's probably better if you don't name names, right? But can you give me an example of what you mean when you say that it eliminates risk for fiduciaries?
Yeah, I mean, if you're a fiduciary, that means the transactions you're doing are on behalf of somebody else with their capital, right? In an asset management context.
Right.
So you're not, first of all, you're not able to be the custodian. You don't custody your client's assets. You use a custodian for that.
Because there's supposed to be a separation between a fiduciary and a custodian?
Well, yeah, I mean, you're not, if you're in a regulated market, performing a regulated activity, you're just basically barred from custodying your own client's capital. So, and we hear this term, qualified custodian and so forth. So
everyone loves that.
So that's, the bottom line is you're not going to take your client's money. Let's say you're running a fund. You're not going to take your client's money and go put it up at a bunch of retail exchanges where you now have hacking. That's a non-starter for most people that I think about in the truly institutional world that are fiduciaries.
Right on.
It's it should be that way in the crypto world, and it will get there. But there's people that are running other people's money in the crypto world that don't see the world quite that way, because they're crypto sort of native folks, and so they just aren't thinking about it from the same point of view. The other thing that you can't do is you would never take client money and wire it to some dealer, not even the biggest dealer in the world. You wouldn't wire them money and wait for them to send you Bitcoin. You just could not do that with your client capital as a fiduciary. So when I say that we're suitable for fiduciaries, more suitable than any other solution, what I mean by that is that you can truly eliminate your counterparty and settlement risk and participate in the market. So you don't have to go invest in a fund to get crypto exposure. You don't have to go to the derivatives market to get crypto exposure. You can actually do this in the spot market. You can actually tap into retail exchange and dealer liquidity in a convenient way where you don't have to do your own aggregation, because there's very limited liquidity on any individual exchange or with any individual dealer. We do all that work for you, and you can do that through a custodial account where you literally don't have any counterparty or settlement risk.
I think that's fascinating.
Yeah, and there are people that are misusing the term prime brokerage as if what it means is accessing lots of different counterparties via one account, and that's really a byproduct of prime brokerage. So if you look back to the traditional markets, the point of prime brokerage is to eliminate counterparty and settlement risk. It's so you and I can trade without worrying about each other. The fact that that lets me access more counterparties is a byproduct of that mechanism that eliminates the counterparty and settlement risk.
The trust, you mean?
Right. And so in the digital space, if I go to, and again, I don't want to name names, but there are many folks out there now calling themselves prime brokerage, and there's really only two flavors of aggregation that exist besides what we're doing. We're true aggregation, where in other words, we don't take your money and then put your money at the exchanges or set up unsecured credit lines with the dealers. Because the people that are doing that, they may give you one account and they may go out and execute those trades on an agency basis on your behalf, but they're giving you not only counterparty risk to themselves because they hold your capital, but they're then giving you counterparty risk to everybody where they place assets at exchanges and every dealer that they have an unsecured credit line with. And so people don't understand that, but people in the traditional markets do understand that. So they're not going to use that type of a solution, to access the markets. And then the other flavor of aggregation that people are doing is really one where they really just do the technical work of doing all the API connectivity. They can show it to you all in one order book with attribution, perhaps. But you have to have an underlying account with each underlying exchange or an underlying credit line with each dealer in that mix in order to make it tradable, meaning it's not truly tradable as an aggregation.
Or it's not truly, it sounds more like that there's settlement risk. That's really what you're saying, right?
At the end of the day, that's the bottom line. I mean,
right.
I mean, if any one of these startup companies, are holding your capital, if they're putting your capital at exchanges, if they're doing transactions on your behalf with dealers on credit, where in other words, where the dealer is not collateralizing the other side of the transaction, you are taking all of that counterparty risk. So that is really, if you were to ask me, why have we not seen true institutional adoption? It used to be custody, right? That's clearly improved, and all of the big banks are going to be in the space, call it over the next 18 to 24 months based on the conversations I'm having. The problem now is really counterparty and settlement risk.
So how has custody been solved? How has that problem been solved?
Well, it's been solved by...
Sorry, I'm just looking at my levels, making sure that,
Yeah.
I'm not blowing out everyone's ears.
It's been solved by virtue of good companies coming to the space, getting regulated in proper ways, having the right kind of technology to basically minimize operational risk. It's been insurance wrappers around some of that. Custody is definitely, in my view, largely a solved problem, and there's really just perhaps certain regulatory or moral hazard issues, if you want to think about it that way, that are the reasons why we don't see the big custodial banks in the space yet. They're kind of waiting for some other stuff to happen before they get there. But that's custody.
But I find custody to be interesting because about a year ago everybody was talking about custody and how it's a problem and how it needs to be solved. And I personally don't get how you can really solve custody here, because the blockchain is the blockchain. If you lose your keys, if you lose that code that gives you access to your mailbox that has all of your Bitcoin in it, it's lost. So I guess what you're saying is insurance effectively has solved the custody issue. Is that really what you're saying?
Well, that's a part of it. Part of it is insurance. Part of it is maybe better technologies as well. In terms of how people are actually doing it, better operational controls. There's better people coming to solve the problems.
It's not on some dude's laptop in India.
Exactly, or how we've heard some how Bitco got started. For example, I think Mike in some podcast talked about having a laptop under his couch that had a bunch of friends, assets on it. So I mean those days are gone, right? And you have real players like Fidelity coming into the space, right? And you can imagine a larger custodian with the balance sheets that those guys have, and it's not it wouldn't be a problem to have somebody like a Boney or a State Street, be custodian over even a large sum of digital assets, right? You'd be pretty comfortable with that.
You're showing your age. Isn't it pronounced bone me now? Bank of New York Mellon.
Yeah.
So everyone
depends
understands.
where you put the M.
That's right. All right. So you were talking about custody, and now you're saying that.
Yeah, that was the primary reason why we didn't see institutionalization. Now, I think personally, the real reason we're not seeing it now, and I don't know why. I don't know why this meets with so much resistance, because I hear everybody talking about all the stuff, all their institutional initiatives and all the institutional business they're doing. But by and large, what they're talking about are very high net worth individuals that have a certain threshold of assets. They're talking about proprietary trading shops, which we have to remember. Proprietary trading shops are trading their own capital. They can burn their money if they want to. They don't have any fiduciary obligations. So those folks are in the space, obviously, and without naming names, they're all the usual suspects in Chicago and so forth. And then you have a lot of sort of smaller funds that where they're guys that are just guys from the crypto sphere that are now running some capital and have expertise in cryptocurrency. So those are not people that come from the traditional markets where your sort of fiduciary obligations are sort of branded into your mind, and they're quite comfortable with interacting with a dealer on an unsecured credit line. They're quite comfortable with putting assets at a retail exchange, and I believe though that is the primary reason why. We don't see institutions in the space. It's just because they quite simply cannot transact the way people transact today.
Got you. So it sounds like it's going to change when the amount of people, with the way that the majority of people trading operates, changes. Is that right?
That's right, and it's interesting because if somebody like Goldman stood up and said we're going to prime broke the space, we would truly see institutional adoption coming into the space, because people would be very comfortable with accessing the market through that kind of a mechanism where they know they don't have any counterparty or settlement risk as they transact.
So correct me if I'm wrong, but the only way that anybody could ever prime broke cryptocurrency, it sounds like, is if they use your platform. I mean, like it's because it prevents. The atomic swaps prevent somebody from trading something that they don't own or have. Is that effectively what that's kind of what you're saying, right?
That is a reality. A reality is that in the absence of a party standing up and using their actual balance sheet that's big enough to matter, where literally this ecosystem of dealers and exchanges can transact, and that balance sheet is good to cover any kind of problem or losses between those parties, that's basically what it would take. So
who would ever do that? I mean, that's a huge amount of risk.
It's a huge amount of risk that gets a little, it's multifaceted, right? So part of it is regulatory, because the folks that have those balance sheets are generally banking organizations. They fit into a certain regulatory framework that's different than even maybe a traditional fund manager. So it's part regulatory, it's part sort of just even operational and technical. If everybody in the space were already up to the task of, for example, post-trade messaging into somewhere, so that there could be clearing and settlement in the first place on the back of all those transactions, that would be a step in the right direction. So there's a whole range of issues that make that a very long-term thing that we won't see that for some number of years. It'll eventually happen, but the problem you'll have is the same problem you have in the FX space, where the question then becomes, well, who can qualify? Because it's a credit underwriting situation. So that prime broker when they come in and they say, well, we'll give you $100 million intraday credit limit to go transact with other counterparties in our, that will allow you to face, you've got to have a balance sheet to basically cover any losses from positions of that size that you're running intraday, right?
The prime broker, you mean?
The prime broker is only going to underwrite you as a client
if you've got that money.
If they're pretty sure you're not going to blow through your balance sheet,
right?
So what that means is most people cannot qualify for prime brokerage. And it's the same problem in the FX markets today. Small hedge funds with 50 million, 100 million sometimes cannot qualify to get prime brokerage for their fund. So they're dealing with a tier 2 credit intermediary. They get worse pricing, and we'll have
I didn't know that.
Yeah, we'll have that same phenomenon here, even if somebody like Goldman did stand up and say, for example, do that. So what we've done is create a technology solution to the problem. You still need balance sheet. But what's interesting about the way we've approached it with this multi-custodial blockchain network is that you can now institutionally crowdsource the balance sheet you need for things like short lending or margin financing. So if you want to trade on leverage, you don't need a bank to give you a credit line to accommodate that leverage against your margin deposit you're holding with that prime broker. You can actually have your collateral, your margin, if you will, on the OTCXN network, provably available, at your custodian. And we can then create a marketplace where anybody that has balance sheet that they are willing to lend can do that frictionlessly by holding assets in their own accounts, the custodians, but then setting things like initial margin, variation margin, liquidation margin levels, and their fee. So in other words, people that know how to price that risk can come in and provide a portion of the balance sheet that you need and do it in a way where we don't have to talk to each other and sign paperwork. It can all be programmatically available if you have the requisite collateral on network.
So essentially what you're saying, I'll break it down in a less tradey way. What you're saying is that you can use OTCXN to increase the credit availability so that people can have a margin account, which is essentially trading on credit. And let's just put this in perspective. The reason why we have the society that we have, aside from capitalism, is the use of credit, because it allows people, this is from an economic perspective, not my ideas, someone else's, but it allows people to take money they don't have and use it now instead of waiting. So it increases the flow of capital. So effectively, what you're saying is that the OTCXN platform can be used in addition to what we've already discussed to improve the credit availability in a safe manner so that there's less risk involved, and allow people to trade that don't actually allow people to trade and borrow money that would currently have difficulty using margin and borrowing money for. Is that right?
Yeah, that's roughly right. So so let me make a practical.
I feel like
example.
I lost it at the end of that. So
no, I'll make a practical example. So let's imagine that you have $1 million, on network, and you really want to put on a $10 million position, right? Mm-hmm. So that's an extremely large amount of leverage. I'm doing this just to kind of illustrate the point. If there are people out there that have the $9 million you need to actually have the $10 million to enter into a transaction, that know how to price that risk, and are willing to provide that balance sheet, knowing, of course, that we have a margin engine and that we're gonna programmatically enforce all of the rules that they set. So in other words, if they set a liquidation margin level that means that you would be liquidated if you lost, let's say, $500,000 of your $1 million margin, we're programmatically enforcing that, right? So the idea is that we should be able to prevent. It's very much like what happens in any margin context. Like if you look at BitMEX or the derivatives exchanges in the space, they give you 100-to-1 leverage, but then they basically make sure they close out your position before you go negative. And so it's the same concept here. The difference is that by using this multi-custodial blockchain network, you now open this marketplace up to anybody that can wants to hold dollars or Bitcoin or whatever, could even be a high yield bond portfolio with a haircut that's going to be used as collateral to provide leverage in this context, right? And we're actually having conversations with people about doing things like that. But what's beautiful about it is that everybody maintains control of their own assets in their own accounts at these custodians. We're really just doing essentially repo transactions on chain that essentially earmark the change of ownership while there's risk on. And so, that gives you the equivalent or a way to approximate the kind of leverage you would get from a prime broker, for example, who's putting their balance sheet at risk. So this allows you to sort of drastically reduce the concentration risk of the balance sheet commitments. You could have 100 different firms providing little slivers of that, because it's effectively a marketplace where the people are in the business of earning a rate for providing those assets in that context, right? And so that in my view, that's actually also the solution for how to sort of grow the prime brokerage businesses in the FX space. As the banks are de-risking, we've actually had conversations with tier one banks where they look at what we're doing and they go, we can actually take a prime broker client on, and instead of giving them our credit lines, we could let them essentially, institutionally crowdsource the balance sheet they need or the credit they need, because we can tokenize credit lines too, which is another interesting weird concept. But that would give them the buying power they need without the bank that actually brought them in under their prime brokerage umbrella taking any risk or allocating credit. And so that's a pretty profound benefit to anybody that's in that business.
Because it effectively increases people's ability to trade, right?
It does, yeah. Your velocity of capital. I mean, it brings down the barriers, right? You no longer have. You could make it all. You can, from a practical point of view, it will never be. It's probably not perfectly asset based. There's a continuum here, right? As people get more comfortable with this sort of stuff, but you can truly make it fully asset based, where people are effectively fully funded without actually having to be fully funded.
That's amazing. That's just great. Okay, so let's wind up with some personal questions.
All right.
All right. What's your favorite nonfiction book?
My favorite nonfiction book? Probably the Bible.
I love it. Okay. What's your favorite fiction book?
Favorite fiction book? Oh, man. I don't read a whole lot of fiction.
It could be ever. Okay, so we'll pass.
I'd have to go back to the books I pretended to read in grade school probably for that.
Favorite podcast? How about that?
Favorite podcast?
Don't disappoint me. Don't say that I don't listen to podcasts. That's
not
killer.
You don't mean episodes. You mean just in general podcasts.
Yeah.
I mean, I like. Am I allowed to name names?
Yeah, absolutely.
So I like Laura Shin's podcast because I feel like they're a little bit. They're pretty neutral. She's pretty much just driving at the heart of things, even if they're not pleasant.
That's like the preeminent FinTech podcast, right?
Yeah, I like that. It's very crypto centric. Obviously, I also listen to Pompliano and Off the Chain. I love that
he's
as
great.
Well. And those are also fun.
Okay, now where do you go to learn?
Well, probably like everybody, I go to Google and I find relevant nonfiction material to read.
Okay. All right. And then the last one is, if you were to take all of your experiences and you were to wrap them up into one ball, what's the thing that you would tell any young person to do, and then the thing you would tell any young person to never do?
That's an interesting one. I think for one thing, I would say, especially while you're younger, take a lot of risks. Be willing to take risks. And I think what you want to not do. Just thinking about some of my life lessons here. You want to be careful. You really want to be careful who you surround yourself with and who you're depending on. I think if you want, you definitely have to be willing to. You got to chop the wood yourself. I think it's very hard to totally depend on somebody to come in. It's very. I've made a lot of mistakes around, bringing somebody in just to be the capital raiser, or bringing somebody in, just to perform some function that I didn't love doing myself. And I think when you're in an early stage company, you can't just pass that off entirely. You have to be very much involved in the process, and so those are just kind of two things that stand out in my mind. So on one hand, take lots of risks while you can afford to do so, and before you have 4 kids and all the rest, and then
be wary of specialists.
It's not even specialists. It's just you have to be accountable for your own everything you want out of life. You can't hire everything. You have to really be involved in. And I'm talking about early stage companies, right? This is kind of where I live and breathe. I don't know how you do it in a more sort of buttoned up corporate context, but that's how I run my life now in the startup world.
Great advice for people coming up. Rosario Ingargiola, thank you for coming by.
Yeah, thanks for having me.